Guys, welcome to another risk management video. In this video, we're going to be looking at risk to reward and identifying good and bad trades. This is going to be a shorter video, very simple video. By this point, I assume that many of you guys have already gotten this concept down, but it doesn't hurt to go back through it. So basically what we're going to do is we're going to take just some example setups that we might have, and we're going to look at the risk to reward and identify if we should even take that trade to begin with. So here, small example, we have a counter trend line breach, or a trend line breach, if you will. Let's say we want to sell this breakout, or we're trying to figure out if we should sell the breakout candle. Well, the first question that you have to ask yourself is, where does your stop loss have to go? Your stop loss has to go above here, right, above these highs, somewhere up here, right? And ideally, you'd probably be getting out somewhere in between the high and where your stop loss is at, somewhere in that zone if price were to breach, right? In most cases, obviously in this case, price is going to come up and just breach your stop loss right there. But that's the risk on this trade, okay, 162 pips. That means that for this trade to make sense, you need to at least have 162 pips in the other direction. So if there's anything in the way of that, you should probably reconsider taking the trade. Now, the first thing that I noticed looking at this is that if you look over here within this trend line, you can see there's a clear support right here. Clear support, okay? And now let's see if this is something that we need to be worried about. Look at this, guys. There's a whole zone. Looks kind of like that. Yeah. Look at this SNR in here, guys. Pretty significant SNR. It's every interaction that price has had with it, it's been very well respected, right? So if price gets to this SNR, we would expect that it would at least give some kind of bullish momentum, some kind of bounce. And guys, look, that's going to be where price reverses right there, okay? So if you are looking to take this trade and you identify that this has to be your first take profit zone, you should consider not taking the trade. Now, what can we do in this case, right? So we can't sell this candle, but maybe we can make a secession for ourselves, and we can say, okay, but if price will give me a retracement up into these highs and give me an opportunity that has better risk to reward, I will take this trade, right? So maybe when price does its first retracement, let me zoom in here so you guys see what I'm talking about. See how this candle gave us a retest of our trend line? Maybe we re-identify an entry here, and we check the risk to reward. Does the risk to reward make sense? No, it doesn't. So we're not going to take that. And then we wait, and price comes up into our zone. That's another potential sell opportunity. Does the risk to reward make sense here? What's the answer? The answer is yes. Guys, this is the trade that you take. This is the trade that you should have taken in this situation. And guys, notice how all those other entries, they would have worked, yes, but you would have had a lot higher risk. You would have had a lot lower reward. Guys, if you sold the breakout candle right here, you walked away with 70 pips. If you waited for the correct opportunity, you walked away with over twice that, 160, right? So very simple example. Let's take a look at another one. Trend line breaches right here, guys. You are looking for a sell trade. Stop loss has to go up here. Your first take profit, this is not a significant support. You guys can see it was not respected that well in here. First big one's going to be right here. Does the risk to reward make sense? Yes, you take the trade. Okay, pretty simple. Let's take a look over here. So we have this SNR identified down here. We've got another one right up here to the upside. Okay, right up here to the upside. Let me ask you, and it's actually slightly lower. I'm looking at this right here. Let me ask you, should you take this buy trade when price originally breaches this SNR? And I'm talking about right here, this candle. Should you take that trade? Well, let's see what the risk reward is. The risk is somewhere down here beneath this zone. The reward is right here. So it's a 1.3 to 1. You can take this trade. By the rules, you can, because it's at least 1 to 1. But obviously, guys, in terms of risk to reward, you want better risk to reward. So the best entry is when price, let me move this over here, when price comes back down to our support right here. And then our stop is 40 pips. instead of 60, and our take profit is 100 pips instead of 80, right? So it just makes sense. And doing this kind of analysis, guys, for every trade opportunity that you look at is really important, because you have to really identify, you know, what are you looking to gain from this trade, and is it worth it, right? Because like here's a great example. Look at this, guys. You see how we have this giant wick right here? Well, you know that when you enter a sell trade here, that you have to put your stop above this wick. You don't have a choice. And I mean, you do have a choice, but at that point, you're just gambling if you put your stop loss inside here. You have to put it above this wick. So you need to take that in consideration when you're looking for a sell trade from this area. You know, look how much risk you're going to have. Is it really worth it when you know that your first target has to be right here? Okay, so this is just to give you guys a refresher example on identifying good and bad trades, using risk to reward. This is pretty much like the first thing you should ask yourself before you enter any trade. And honestly, guys, this is really going to improve not only your risk to reward, but your win to loss ratio. You guys are going to find that a lot of times where you're looking to enter a trade where risk to reward isn't fantastic, that it's going to end up being a losing trade anyway. This is something you guys need to absolutely keep in mind. All right, I will see y'all next time. Guys, Cody Sell here. We're going to be looking at stop losses in this video. This is a very, 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 very important topic. As you guys know, from day one, we have recommended using stop losses. There are a lot of traders out there who don't use stop losses because they rationalize that it causes them to be taken out of trades because people are coming to get them. And the people who use that reasoning, A, they're mostly novices. B, you know, they're not consistently profitable traders. There's no way. C, they don't understand market manipulation. And D, they don't understand how to properly use stop losses, okay? And basically, the first thing I'm trying to get out here to you guys is you need to always put a stop loss. Okay, if you can't limit how much of your account is at risk for a given trade, you cannot trade, all right? So I'm just getting out there right off the bat. You need to use stop losses. Now, let's talk about what is the purpose of a stop loss, because I think this is the part that really separates these guys who are having these issues out. And it's because they think that a stop loss should be designed to take you out of a trade at an optimal time. Okay, and that's really where the problem's coming in, because guys, a stop loss should not be used to give you an optimal exit from a bad trade. All right, a stop loss should be placed to protect your account should price find a lot of volatility, liquidity, and go against you. All right, it's not really designed to give you a good exit. In fact, if you use a stop loss appropriately, it's a really bad exit. Okay, and I'm going to show you guys what I'm talking about. So let's take a look here, and let's look at a hypothetical trade situation. Let's look at maybe a couple of them here. So let's put this right here, and let's say that we came up and maybe we had a zone here, and we took a sell. Red. Get this off my screen. Let's say that we entered a sell trade when price came back up into this zone. Okay, just hypothetical situation. And the targets don't matter, right? But in terms of this stop loss up here, a lot of guys who are new or don't understand how to properly use their stops will put their stop loss right here above this zone. And the rationale for that is, well, if price breaches this zone and comes up into this area, I don't want to be in the trade anymore. Okay, and that's fine, but the problem is that you need to be able to have more flexibility than that, right? Because obviously, look what happened. Price gave a little wick, came back down. Do you really not want to be in the sell trade anymore just because of that? Obviously, no, right? Price held. There's no reason to exit this trade. And so that's going to be where the separation occurs. And everyone who put their stops right above the zone is going to get taken out. Why are they going to get taken out? Well, either A, it might be just a small fluctuation that was enough to take them out, or B, it might be because this was a push by an institution to take out stop losses, because that happens a lot. Regardless, it's only taking out the retail traders, right? The people who don't really know what they're doing. The correct placement, guys, for a stop loss in this case is something up here, way up here, out of the way. Nowhere near where it should actually be triggered. Guys, if your stop loss gets triggered, it should be a rare event. What I'm saying, guys, is that you need to be prepared to exit your trades manually when possible, right? And I know that some people have work and they have families, and guys, if that's the case, you need to trade the higher time frames, or you need to trade the very low time frames, where you can either A, block off 4 hours a day to trade and get a lot of trade opportunities in by trading the 5-minute, or B, trade the 4-hour daily chart where you can check once, twice a day and manage your trades, because guys, you need to be prepared to exit manually. So what would that look like? Let's say price gave you a green candlestick that closed on the other side of this zone. You would then close your trade manually right here, minus 35 pips. You do not, however, want this green candle to hit your stop loss. This should not hit a stop loss. Your stop loss should be up here to protect you from something like this that might come in at maybe an NFP news event or whatever it might be, right? You don't want to be in a trade if something like that happens, but guys, your stop loss is for protection only. All right, let's look at another example. Let's say we took a sell trade again, same setup right here. Right here, we just entered the sell trade, right? People will tend to put their stops right in here. And in this case, yeah, price stops it out, and they might think, okay, that's a fair exit. But in reality, they shouldn't have been stopped out. Their stop should have been up here. They should have manually exited at the close of that green candle. Okay, and the crazy thing is, guys, is people think that by putting their stops really close like this, they're really giving themselves, great exits if price continues on. And guys, honestly, most of the time, if you close manually, you get a much smaller loss, right? So like, let's say in this case, if the stop loss was like up here, right, and it gets hit, but notice how when the candle closes, it comes back down like 50%. So that's half the stop, guys. So that's those are just examples, and there are a lot of examples, guys. Look right here. Let's see you sell at this resistance. Very simple trade setups. I'm just trying to give you guys an idea. Anyone who puts their stop loss just above is going to get taken out, right? Stop needs to be up here. What is this to protect you from, right? Guys, right here. This is what a stop loss is meant to protect you from. You might take a buy. Let's say you go long right here. Your stop loss is down here as a protection against giant red candles. And in this case, obviously price shot right back up. But oftentimes when that happens, price continues on for a major reversal. And let me see. Oh, I know a great example, actually. Let me pull up Euro USD. Euro USD likes to kill retail traders. Get rid of all this. Duplicate that. I'm going to leave that because I have that marked up for some guys in the group right now. And let me clear all this off. So let's take a look at this, right? Let's say that we're in this downtrend here, and we buy this breakout candle, okay? You buy the breakout candle, and you're going for up here, right? Now, let me go down to the floor. All right, so let's take a look at this. So what's going to happen when you buy that breakout candle? What most people are going to do with their stops is they're going to place their stops just beneath the low. That makes right about there, right? That makes sense, right? Because price shouldn't breach the low if it's going to go bullish. And while that may be correct, what they're saying makes total sense, and you guys know that because you've gone through the training. But what doesn't make sense is putting a stop loss right there, because guys, price is going to wick through. I mean, it happens almost every time. In fact, if you guys want to see how consistently price is going to come and try and take out your stop losses, it doesn't take me going to another zone. I can show you right here. Here's your sell trade right here. Boom, there's your stop hunt. Here's your sell trade right here. You got a double top formation, flag formation, counter trend line lower, however you want to look at it. Boom, price flies through, takes you out. Right over here. Guys, look at this. right here. You take a sell trade up here, wicks through, takes you out. Guys, literally, if you look at every single reversal spot in the market, price comes back through to take you out, right? It breached the wick there. It breached these low. Look, guys, price held here. Okay, it just came to take you out. Almost every major reversal area in the market. Look at these wicks that came through, right? Originally, if you sold, stop loss just above, it's going to come get you. Okay, the reversal spots in the market, guys, they are designed to take out retail trader stop losses. Look at this. Look at this, guys. Stop losses were all put just above just to take people out and piss them off. But the problem is that people don't know how to use stops, which is why it gets them. Okay, and I encourage you to go through and look for yourself. But guys, stop losses, it's a very simple concept that I'm dragging out because it's so often misunderstood. Stop losses are to protect your account. They are not to exit your trades when you are wrong. When you are wrong, you need to exit your trade manually based on whatever criteria you have set for the trade. If you enter a trade based on a trend line breach, you need to exit the trade if price comes back within your trend line. If you enter a trade based on a support and resistance breach, you need to exit the trade if price comes back through your support and resistance. If you enter a trade based on structure breach, you need to exit your trade if structure breaches the other way, right? It's a fairly simple concept, but guys, it makes such a huge difference in your trade success. So I hope that you implement this in your trading. I'll see you guys next time. In this video, we're going to be talking about trailing stop losses. So we get to question a lot of times, we're not huge fans of trailing stops. We're really not fans of anything that is designed to make trading more quote unquote hands-free or automated for you. You guys should run from things like that because obviously if everything in life was that easy, everyone would be millionaires, and nobody would have to get up for work the next morning. So, there's a more sound reason why this doesn't work, and we're going to walk through a hypothetical trade situation which I've already identified here in front of us. And let's just say that we took a short trade here as price approached our resistance zone here, recent high resistance zone, and let's say that we were shooting for a downside target right in this area. Okay, now what's going to happen, and let me get my horizontal line here. Oh, that's not what I wanted actually. I want my horizontal ray, and let's make it red to symbolize that this is a stop loss. Okay, so we're going to start off with our stop loss right up here as shown. But then what's going to happen is as we start to move down, what are we going to do? Well, the first thing we're probably going to do is we're going to move it just above this peak right here. Okay, and what's going to happen? Let me move this over here. What's going to happen when we do that? Well, price is going to come up, take us out, and then fly down, right? So you got to ask yourself, did it really make sense for you to be exited out of this trade at this time? Okay, think about that. Did it make sense for you to be out of this trade right here? And the answer is no. Okay, no matter how you want to look at this, the answer is no. And even if you wanted to do a structural analysis, horizontal line here, you might be able to justify, well, hey, structure broke, so for that reason I'd like to be out of the trade. But here's the thing, structure didn't even break here. Price might have breached it, but if you noticed, it never was able to retest. It fell right back in each time. It breached, fell back in, breached, fell back in. Price held. You guys know the definition of a break is that it must also hold as a retest. Price didn't do that here. Okay, and that happens a lot, guys. So you're going to get taken out. Now let's say, for argument's sake, that you're still in the trade. Maybe you kept it up here for some reason, or you didn't move it yet. The next possible spot to move your trailing stop loss would be down here, right? Above these peaks right here. And look, guys, what's going to happen? Price is almost going to hit your TP, and then you're going to see a giant wick, which is designed, guys, this is designed to take out retail trader stop losses. And then price is going to go on to hit your TP. Guys, it doesn't make any sense for you to be out of this trade here. But if you're trailing your stop down, you're going to get taken out of this trade. Okay, and it just doesn't make any sense. And guys, that's one of the things, and I know we haven't gone over this yet, market manipulation, but guys, this is what the institutions use to destroy retail traders. They know where you guys are putting your stop losses, and they want to take you out because they make money when you lose money, right? That's where your money goes. It goes to their pocket. So they know after all these rejections right here that all the retail traders who are in sell trades are going to move their stops just above here. And that's why this happened, guys. And this it's every time, right? I can even take you over here. Let's say that we're in a buy trade over here. Let me go ahead and mark it. We're in a buy trade down here now. Okay, again, we're heading back up. Our targets are up here. Guys, look what happens if you trail this stop loss. Okay, if you trail it too close, then you're going to move it under this valley created right here. It's going to take you out, and right after it takes you out, guys, it's going to keep going, right? Let's say you kept it farther away. Maybe you want a more significant valley before you move it up. So you move it up to this one, and then you move it up to this one, and then you move it up to this one. Guys, what's going to happen? Okay, did price actually breach these lows right here? No, it didn't. It breached and then flew right back in, right? So we did not break structure. We did not break these lows. We did not make a new low. But you got taken out of this trade down here when you should have been taken out of this trade for TP right up here. Okay, so that's an example of why you wouldn't want to trail your stops using highs and lows, guys. Price does come to take you out all the time. All right. Now, what if you implemented, some people will ask, a trailing stop that automatically goes 10, 20, 30, 40, 50 pips and just kind of follows you down as you go? Well, let's figure out what happens there, okay? Let's say that we come back to our original sell trade here, and let's say that we're trailing, 50%, okay? So 50% of the trade. Well, guys, after this low down here is created, we come down right here, and then we make a new low, and 50%, we're probably somewhere right in here. Okay, guys, whatever pips you might want to call this, 20 pips, 30 pips, whatever, you're going to get taken out prematurely. Same thing here, whether you're following the highs or lows or you're just trailing it by a pip count. Guys, most of the time, and honestly, when you trail it by a pip count, it gets even worse, guys. Like your exits seem to get even worse because you have to understand, like, price moves. Like everyone who uses trailing stops, guys, they don't understand this. Price doesn't just go up, okay? And that's the only reason a trailing stop, where's my little trailing stop thing? That's the only reason why a trailing stop would work. If price just went up, 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 up. Or you could argue a trailing stop would work if price did very small pullbacks, right? And that was it. And price just did these very small pullbacks all the way up. Because then if you're trailing with a reasonable trail, as price retraces, it won't get all the way to your trailing stop loss, whether it be 10, 20, 30, 40, however many pips you have it trailing. But guys, how does the market really move? We've been over this over and over again. The market goes up, and the market comes all the way back. It can come this far, okay, and then it can go. Or the market can go up to here, and it can come this far, and then it can go. Or the market can go up to here, and then it can come all the way back down to the origin of the move and still go and still hold structure right here. Okay, you guys know that. So at any point with a trailing stop coming in, it's going to get taken out prematurely a lot of the time, guys. And if you simply understand market structure, you know that you can't just put a trailing stop on there and go for it, because guys, there are times when the retracement is huge. You'll see price make a huge move, okay? And this could be, guys, like this could be a 200 pip move to the upside, and you might be trailing your stop like 40 pips, all right? So it's in here. Guys, come on. It doesn't take anything to take that out and go. So trailing stops, we're not a fan of trailing stops. You can catch pips with trailing stops, but when we talk about optimal exits, guys, catching the most out of your moves, the best way to exit trades is to have an idea of where you want to get out and try and not necessarily, I hate the word predict, but you want to use confluence to understand when the best time to get out of your trade is, guys. And it's never going to be when the market comes against you. Think about it, guys. If you're in this buy trade right here, you want to get out up here, right at the very top. You don't want to wait for sellers to come in. That doesn't make any sense. You just took out a quarter of your profits for no reason. You literally marked a zone where you said, I think I should get out of the trade here because it looks like sellers keep coming in at this spot. And yet you held through and waited for sellers to come in and take all of your profits. Guys, that doesn't make any sense. That doesn't make any sense at all. And if you understand that, you understand why trailing stops don't make any sense either. Trailing stops are literally, you're saying that you want price to come against you and take you out before it goes forward. That doesn't make any sense. Why would you sit here and wait for price to come against you just to take you out at the worst possible time and then go? Okay? And guys, I've shown very few examples here, but I promise you, if you open up the charts and you look at any trades that you might have taken, or maybe even any of your previous trades, and you implement a trailing stop, you're going to see how many times you're taken out of trades prematurely. And it's just, guys, it's not a great way to trade. You can use trailing stops if you have no other options, but this, guys, is not what we would like to see you guys doing. It's not how we trade the markets, and it's definitely not how we recommend you guys trade it. We just wanted to kind of explain the reasoning behind this, because we know that a lot of people do use trailing stops, and we get the question a lot. So I hope you guys understand why we feel that way about them. If you don't, rewatch the video or go into the charts yourselves and check it out a little bit more. And if you still have questions, don't be afraid to reach out to one of us. All right, see you guys in the next video.